Hello everyone, welcome back. In this lesson, we're going to go deep into two very important concepts, arbitrage and the delta neutral strategy. These two ideas are the foundation of our funding rate arbitrage method. Once you understand them fully, you'll know exactly why this strategy is safe, stable, and suitable, even for beginners. So let's start with the first idea, arbitrage. Arbitrage simply means taking advantage of price differences for the same asset on different exchanges. The logic is straightforward. You buy low in one place and sell high in another. And if you can do it fast enough, the profit becomes almost risk-free. Let me give you a simple example. Imagine Bitcoin is priced at $50,000 on exchange A. At the same moment, on exchange B, the price is slightly higher at $50,200. If you buy one Bitcoin on exchange A and immediately sell one Bitcoin on exchange B, you instantly make $200. That $200 comes from a temporary market inefficiency, where the two exchanges haven't updated to the same price. However, these opportunities only last for a few seconds, sometimes even less than 1 second. And to catch them successfully, you need super fast internet, high-frequency trading systems, and professional trading software. For normal traders like us, classic arbitrage is almost impossible to execute consistently. The price gap disappears too fast, and the fees can easily wipe out your profit. But the good news is, the crypto market gives us another kind of arbitrage, one that is easy to execute, requires no special computer, and can be very consistent. This is called funding rate arbitrage. To understand why funding rate arbitrage works, we need to understand the purpose of the funding rate. Funding rate is a periodic payment exchanged between long traders and short traders on futures exchanges. Its job is to keep the futures price close to the spot price. When more people are opening long positions, the futures price becomes higher than the spot price. The funding rate turns positive, and the long traders are required to pay the short traders. This discourages excessive long positions and brings the futures price back down. On the other hand, when more people go short, the futures price falls below the spot price, the funding rate becomes negative, and this time the short traders pay the long traders. This encourages buying and pushes the futures price back up. Every exchange has its own group of traders with different behaviors, different emotions, and different market preferences. And because of that, the funding rate for the same coin can be completely different on two different exchanges at the exact same time. And this is exactly the opportunity we want to capture. For example, imagine that on exchange A, the funding rate for a certain coin is plus 0.05%, while on exchange B, the funding rate for the same coin is minus 0.03%. This is a perfect arbitrage opportunity. You simply open a short position with the same size on exchange A, and a long position with the same size on exchange B. At funding time, for example, at midnight, 8 a.m., or 4 p.m., you will receive the funding payment from both exchanges. You will receive 0.05% from exchange A and 0.03% from exchange B. In total, you earn 0.08% for that cycle. If the funding rates stay the same for the whole day, you receive this amount 3 times, and 0.08% multiplied by 3 gives you 0.24% per day. It may not look like a big number at first, but it is extremely stable. And when you use leverage carefully, it becomes very meaningful. And the best part is, you are not predicting direction. You are not trying to guess whether the price will go up or down. Your profit comes entirely from the market structure and the funding payments. To do this safely, we need to understand the delta neutral concept. A delta neutral strategy means your long position and your short position cancel each other out. If the price goes up, the long position makes money, but the short position loses money. And if the price goes down, the short position makes money and the long position loses money. The gains and losses balance each other. As a result, your profit does not depend on price movement. Your profit depends on the difference in funding payments. This is the reason why the strategy is so safe. When you long and short the same size of the same coin, the overall exposure becomes neutral. You are not affected by normal price fluctuations. Your unrealized loss on one side will be offset by the unrealized gain on the other side. The only major risk is liquidation, which happens when leverage is too high or margin is too low. But later in this course, I will teach you exactly how to manage your leverage, how to avoid liquidation, and how to run the strategy smoothly. So, in summary, arbitrage means taking advantage of price differences. Traditional arbitrage is difficult for normal traders, but funding rate arbitrage is simple, low risk, and reliable. And the delta neutral structure protects you from price movement, so you only earn from the funding rate difference. Now that you understand these concepts deeply, you're ready to move on to the next lesson, where we start setting up the actual funding rate arbitrage positions step by step. Let's continue.